Welcome to my books and storytime by mybookssummary.com. In the investment answer, Daniel.C.Goldie and Gordon S. Murray provide a simple yet powerful guide to investing that helps readers make better financial decisions. The book, written in an easy-to-understand style, is particularly aimed at those who are unfamiliar with investing or who have been misled by financial industry myths. It breaks down investing into 5 essential decisions that every investor must make, offering practical and research-backed advice to help readers secure their financial future. Goldie and Murray emphasize that successful investing does not require market timing, stock picking, or complex financial strategies. Instead, it is about making smart, disciplined, and evidence-based choices. The book is designed to provide clarity in a world where financial advisors and Wall Street firms often overcomplicate investing to their benefit rather than that of the investor. The authors, both experienced in finance, take a straightforward approach, advocating for low-cost, diversified investments that align with an individual's goals and risk tolerance. Decision 1. Who should manage your money? The first critical decision in investing is choosing whether to manage your investments yourself or to seek professional guidance. The authors make a compelling argument for using a fee-only fiduciary advisor rather than attempting to navigate the financial markets alone. Many investors are lured by the illusion that they can outperform the market with enough research and effort. However, the reality is that most individuals lack the time, expertise, and emotional discipline needed to consistently make wise investment choices. Goldie and Murray caution against commission-based financial advisors, who often prioritize their earnings over the investor's interests. Instead, they advocate for fiduciary advisors, professionals who are legally obligated to act in their clients' best interests. These advisors work on a fee-only basis, meaning they do not earn commissions from selling financial products. This distinction is crucial because it ensures that the advice given is unbiased and aligned with the investor's financial well-being. For those who prefer to manage their own investments, the authors emphasize the importance of education, discipline, and avoiding emotional decisions. Many investors fall into the trap of chasing trends, acting on short-term market movements, or attempting to predict economic downturns. This behavior often leads to buying high and selling low, which is the exact opposite of successful investing. Decision 2. How should you allocate your assets? Asset allocation, the process of deciding how to divide your investments among different asset classes, is one of the most important investment decisions. Goldie and Murray explain that asset allocation is the primary driver of investment returns and risk. Studies show that more than 90% of portfolio performance is determined by asset allocation, rather than individual stock selection or market timing. The authors categorize investments into 3 broad asset classes: stocks, bonds, and cash. Each of these has distinct characteristics and plays a different role in an investment portfolio. Stocks provide long-term growth but come with higher volatility. Bonds offer stability and income but have lower growth potential. Cash is the safest option but provides minimal returns. The right mix of these assets depends on an investor's financial goals, risk tolerance, and investment time horizon. A young investor with decades before retirement may benefit from a stock-heavy portfolio, as they have time to recover from market downturns. Conversely, an investor nearing retirement may prefer a more conservative portfolio with a higher allocation to bonds, ensuring stability and income. The key is to create a diversified portfolio that balances risk and reward according to individual needs. Goldie and Murray highlight the importance of staying invested and avoiding frequent changes to asset allocation based on market conditions. Many investors panic during market downturns and shift to safer assets, locking in losses and missing out on future recoveries. A well-allocated portfolio should be built to withstand market fluctuations, allowing the investor to remain confident through economic cycles. Decision 3. How should you diversify your portfolio? Diversification is another cornerstone of smart investing. The authors stress that putting all your money into a few stocks or a single asset class is extremely risky. Instead, investors should spread their money across various investments to reduce overall risk. By diversifying, an investor can protect themselves from the impact of any single investment performing poorly. Goldie and Murray advocate for global diversification, which means not only investing in domestic stocks but also including international equities, bonds, and real estate investment trusts, REITs. This broad exposure ensures that an investor benefits from growth in different regions and sectors, reducing reliance on any single economy or market. One of the most effective ways to achieve diversification is through index funds or exchange-traded funds, ETFs. These funds automatically spread investments across hundreds or thousands of securities, eliminating the need for individual stock selection. Unlike actively managed funds, which attempt to beat the market, often unsuccessfully, index funds simply track a market index, providing consistent and low-cost returns. The authors warn against concentrated investments, such as holding too much stock in a single company, especially one's employer, or focusing too heavily on a specific sector. These concentrated bets can be devastating if the company or sector faces financial trouble. A properly diversified portfolio reduces such risks and provides more stable long-term growth. Decision 4. Should you attempt to time the market? Market timing, the strategy of trying to buy low and sell high, is one of the most common mistakes investors make. Goldie and Murray strongly discourage this practice, explaining that even professional investors struggle to consistently predict market movements. The stock market is influenced by countless unpredictable factors, making it nearly impossible to time entry and exit points accurately. The authors illustrate how missing just a few of the best days in the market can significantly impact long-term returns. Investors who try to jump in and out of the market often end up missing key growth periods, resulting in lower overall performance. Instead of trying to time the market, the best strategy is to stay invested through all market conditions. They also highlight the role of behavioral biases in market timing. Fear and greed often drive investors to make irrational decisions, panic selling during downturns and overbuying during market booms. A disciplined, long-term approach eliminates the need for emotional reactions, leading to better investment outcomes. Goldie and Murray advocate for dollar-cost averaging, a strategy where investors consistently invest a fixed amount at regular intervals, regardless of market conditions. This approach ensures that investors buy more shares when prices are low and fewer when prices are high, reducing overall investment risk. Decision 5. What should you pay for investment services? Fees and costs can erode investment returns over time, making it crucial to minimize expenses. Goldie and Murray emphasize that high fees do not necessarily equate to better performance. In fact, studies show that higher-cost funds often underperform lower-cost alternatives. Many investors unknowingly pay excessive fees through actively managed mutual funds, commission-based advisors, and hidden brokerage charges. The authors advocate for using low-cost index funds and ETFs, which provide broad market exposure at a fraction of the cost of actively managed funds. Additionally, they caution against financial products with high expense ratios, front-end loads, or hidden transaction fees. Investors should always be aware of what they are paying and ensure that their fees are justified by the value they receive. The goal should be to maximize returns while keeping costs as low as possible. Final thoughts. The simplicity of smart investing. The overarching message of the investment answer is that successful investing does not require complexity. Goldie and Murray distill investing into a straightforward and research-backed approach. Use a fiduciary advisor, allocate assets wisely, diversify broadly, avoid market timing, and minimize costs. The book serves as a powerful reminder that patience, discipline, and simplicity are the keys to building long-term wealth. By following these principles, investors can avoid common pitfalls, reduce stress, and achieve financial security with confidence. Stay tuned for more enlightening content. Head over to www.mybooksummary.com. Don't forget to subscribe and share the magic with friends. And let's grow together through the power of books and interesting stories.